In chemistry, a reaction only happens when the conditions are right. It's no different in real estate. Welcome to the Alkaline reaction, a podcast from Alkaline Advisors, where we break down the deals, partners, and capital structures that turn opportunities into outcomes. I'm Spencer Correnti, and today's reaction, one of the biggest drivers of real estate after tax returns, depreciation. Depreciation isn't cash flow. It's a tax deduction, but it can materially change what investors keep, especially in stabilized assets and value-add strategies. Before we start, quick disclaimer, I am not a CPA, not a tax attorney, and not a tax professional. This segment is educational in nature. Tax rules vary by investor and deal, so always consult your own tax advisor for decisions specific to any real-world scenario. In this episode, we're going to discuss depreciation in 6 distinct segments, with examples and mini case studies. First, what depreciation is and what it isn't. Second, the land versus building rule. Third, depreciation schedules and why they're predictable. Fourth, cost segregation and how investors accelerate depreciation. Fifth, bonus depreciation and why timing matters. Sixth, depreciation recapture at exit. With that, let's dive in. Segment 1. What is depreciation? Depreciation is a non-cash expense that allows real estate owners to deduct the cost of a building over time, based on the idea that a building has a useful life. The key point is this: depreciation can reduce taxable income without reducing cash flow. Here's a simple example. Imagine a small industrial building that generates $200,000 in net income. The owner doesn't spend that $200,000 fixing the roof that year. The cash stays real, but depreciation still allows a deduction tied to the building's wear and tear. So the owner might report far less taxable income than the cash they actually received. That's the definition of a paper expense. It impacts taxes, not the bank balance. Segment 2, the land versus building rule. A critical rule: land is not depreciable. The building is. So when you buy a property, the purchase price is allocated between land value and building value. Only the building portion becomes the depreciable basis. Example, you buy a retail center for $5 million. An appraisal allocates $1.5 million to land and $3.5 million to building. That means your depreciation is based on $3.5 million, not $5 million. Two investors can buy the same asset for the same price, but their depreciation outcomes can vary depending on land allocation assumptions. Segment 3, standard depreciation schedules. In the US, depreciation is generally calculated on long schedules. Residential rental property, like multifamily, is generally depreciated over 27.5 years. Most commercial property, like office, industrial, and retail, is generally depreciated over 39 years. The practical takeaway is predictability. You can model this. Example, if you acquire a stabilized apartment building and your depreciable basis is $11 million, you can estimate roughly $400,000 per year in depreciation. That's not exact, but it's a strong underwriting level estimate to understand after-tax impact. Depreciation becomes relevant because it can reduce taxable income even when a property produces positive cash flow. Here's a mini case study. Assume a multifamily acquisition at a $12 million purchase price, allocated as $2 million to land and $10 million to building. Annual net operating income is $900,000. After debt service, annual cash distributions to equity are $400,000. Annual depreciation is roughly $10 million divided by 27.5 years, which is about $364,000 per year. So investors receive $400,000 of real cash distributions, but depreciation of roughly $364,000 offsets a large portion of taxable income associated with that cash flow. This is why two deals can have the same cash-on-cash return, but very different after-tax outcomes. Segment 4, cost segregation. Now, let's introduce cost segregation. Cost segregation is an engineering-based analysis that reclassifies certain components of a property into shorter-lived categories. Instead of depreciating everything over 27.5 or 39 years, portions of a property, if they qualify, can be depreciated faster, often over 5, 7, or 15 years. Here's why this matters in the real world. Scenario: a sponsor buys a value-add apartment building and plans to renovate 60% of the units. In year 1, the sponsor might be executing renovations, leasing units, and managing higher expenses. Cash flow exists, but it's not fully optimized yet. A cost segregation study may identify components like appliances, flooring, fixtures, and certain site improvements that can be depreciated faster than the overall building. That acceleration can increase early year deductions, which can improve after-tax outcomes during the highest execution risk part of the business plan. The key word is timing. Cost segregation generally does not change total depreciation over the life of the asset. It pulls forward deductions into earlier years. Segment 5, bonus depreciation. Bonus depreciation is a separate tax concept that can allow a percentage of certain qualifying property to be expensed immediately in year 1, rather than depreciated over time. In real estate, bonus depreciation usually doesn't apply to the entire building. It most commonly shows up through cost segregation, because cost segregation identifies components that qualify for shorter depreciation lives, like certain personal property or land improvements, and those are often the categories that may qualify for bonus depreciation depending on the rules in effect. Historically, bonus depreciation was 100% for qualifying property. Under a phase-down schedule, it has been stepping down. For example, it was 60% in 2024 and 40% in 2025 under prior law, and it was scheduled to keep decreasing. More recently, there's been policy movement toward restoring immediate expensing for qualifying property placed in service after early 2025. The phrase that matters operationally is placed in service. That generally means the improvement or property is ready and available for its intended use, and that date can matter as much as the purchase date. Here's a more detailed example. Assume an operator acquires a multifamily property and executes a renovation program. Over the first 12 months, they invest $1.5 million into unit upgrades and property improvements, things like flooring, appliances, fixtures, lighting, and certain exterior upgrades. A cost segregation study is performed. The study identifies that of that $1.5 million, roughly $900,000 qualifies as shorter-lived property, meaning it's eligible to be depreciated over 5, 7, or 15 years instead of 27.5 years. Now, without bonus depreciation, that $900,000 still gets depreciated faster than the building, but it's spread out over several years. With bonus depreciation, a percentage of that qualifying $900,000 could potentially be expensed immediately in year 1. Let's keep the numbers simple. If 40% bonus depreciation applies in that year, the investor may be able to expense roughly $360,000 of that qualifying improvement basis immediately, while the remaining portion follows the shorter depreciation schedule. The practical impact is that the deal may generate significantly larger deductions in year 1 than investors expected under straight-line depreciation. This is why bonus depreciation is so often discussed in value-add strategies. It can shift deductions forward into the period where renovations, lease-up, or operational instability are highest, which can improve after-tax outcomes during the exact part of the business plan where investors want the most protection. Now, here's the important caution. Bonus depreciation is timing sensitive. If improvements aren't placed in service until a later year, meaning units aren't rent ready or the improvements aren't operational, the depreciation treatment can shift. This is why sponsors document renovation completion dates and coordinate with tax teams, because the placed in service timing drives the outcome. And again, I'm not a tax professional. The rules are specific, and investors should confirm eligibility and treatment with their CPA. Segment 6, depreciation recapture. Now let's talk about the other side of the equation, depreciation recapture. Depreciation isn't a free benefit forever. When you sell a property, some of the depreciation you took during ownership can be recaptured, meaning it increases the taxable gain recognized at exit and may be taxed at different rates than the rest of the capital gain. Conceptually, here's why. When you take depreciation, you're reducing your tax basis in the property over time. Your basis is essentially your starting point for calculating gain or loss. So depreciation improves annual tax efficiency, but it also reduces the basis, which can increase the taxable gain when you sell. Here's an example. Assume you buy a property for $12 million, with $10 million allocated to the building basis. Over a 5-year hold, assume you take $2 million of total depreciation deductions between standard depreciation and accelerated depreciation from cost segregation. Now, imagine you sell the property for $16 million. Your gain is not simply sale price minus purchase price. Your gain is sale price minus your adjusted basis. And your adjusted basis has been reduced by depreciation. So in this example, your adjusted basis becomes $12 million minus $2 million, or $10 million. That means your taxable gain is $16 million minus $10 million, or $6 million. Whereas without depreciation, it would have looked like a $4 million gain. That extra $2 million difference is essentially the depreciation that was previously deducted and is now coming back into the calculation. This is the important institutional takeaway. Depreciation often creates a timing benefit, improving after-tax cash flow during ownership, but it can increase the taxable amount recognized at exit. Now, this doesn't mean depreciation is bad. It means depreciation must be planned. Sophisticated investors manage this in a few common ways. One approach is long-term hold strategies, where investors prioritize tax efficiency during ownership and reduce the likelihood of frequent taxable exits. Another approach is refinancing. Refinancings can return capital to investors without triggering a sale event, meaning investors can potentially access liquidity without immediately recognizing capital gains. Another strategy is tax deferral approaches like 1031 exchanges, where investors roll proceeds into another asset and defer recognition, subject to strict rules and execution discipline. The bigger point is this: depreciation impacts full cycle underwriting. If you only model depreciation as a benefit during the hold and ignore recapture at exit, you're not modeling the deal correctly. Depreciation is part of the structure. Recapture is part of the exit. Institutional capital evaluates both. Now here's a quick comparison. Deal A distributes $450,000 per year, but has limited depreciation benefits because of basis allocation and limited qualifying components. Deal B distributes $400,000 per year, but generates substantial depreciation and cost segregation benefits early in the hold. On a pre-tax basis, Deal A looks stronger. On an after-tax basis, Deal B can be materially better, depending on investor profiles, because the after-tax cash kept by investors may be higher. That's why institutional capital evaluates after-tax outcomes, not just headline yield. So to recap what we covered today, we define depreciation as a predictable, non-cash deduction tied to the building, not the land. We showed how land allocation changes the depreciable basis. We covered the standard schedules, 27.5 years and 39 years, and why depreciation can be modeled. We walked through a multifamily case study showing how distributions and taxable income can diverge. We explained cost segregation as a timing strategy that accelerates certain components into shorter schedules. We added bonus depreciation as potential year one expensing, with placed in service timing as a key variable. And we closed with depreciation recapture as the exit side consequence that has to be understood in full cycle returns. The takeaway is this: if you underwrite deals based only on pre-tax returns, you're missing a meaningful part of investor outcomes. Depreciation strategy, including cost segregation and bonus depreciation, can materially shape after-tax performance. That's today's reaction. If you found this episode helpful, please subscribe and join us next time as we continue breaking down the commercial real estate industry. I'm Spencer Correnti, and thank you for your time.